Welcome to Leveraging Inspiration, the Inspired Patent Podcast, where we help you understand and leverage your intellectual property. I'm your host, Wayne Carroll. I'm joined with David Blackledge, and we're excited to bring you insights and stories from the success and failures of others and teach you how to win at the game of intellectual property. I always start with a disclaimer. This podcast is for educational and informational purposes only. David and I are attorneys, but we are not providing legal advice. Nothing in this podcast should be construed as creating an attorney-client relationship. In this episode, we're talking about the difference between angel investors and venture capitalists. I want to start with the story of WhatsApp. WhatsApp was the second largest venture capital-backed acquisition when they sold to Facebook for $19 billion when they only had a little over 50 employees. And it's really a Cinderella story, a real life Cinderella story. The founder, he came from Ukraine as a very, very poor immigrant. He worked menial jobs to help himself and his mother to survive. He was right in the tech center of the world. In college, got a job at Yahoo, and things got so busy there. He was very good and learning what he was doing. He quit college because work was so busy he couldn't do both. He later left Yahoo and came up with an idea, WhatsApp. They eventually gathered $250,000 from those close to them, their friends and family, and they were having so much success that venture capitalists started knocking on their doors. They finally accepted Sequoia, a longtime venture capital firm. They accepted $8 million, and then they took on $50 million more dollars. So Sequoia had $58 million invested, which some people estimate was a little under 20%. Their $58 million turned into about $3 billion. Is that a deal you would have liked to be part of, David?
Absolutely. They were involved with venture capitalists, though. I'm not in that world. I'm in the angel investing world. I say with a smile, they probably don't know who I am, but angel investors, a lot of them do know who I am.
What is the difference between venture capital firms and angel investors?
First, let me talk about angel investors. Angel investors are investing in what we call seed round, literally the seeds of a business. It could even be pre-revenue or very, very small revenue scale. You're hoping for a firm to be bought or to go public. Most people don't ever go public. It's very rare, actually. You're looking for someone to get bought and you're trying to get them to scale. They're looking at people that might be in incubators or accelerator programs to help them get the resources they need to scale their business. Angel investors look at the product, and people are getting far more specialized in what products they look at. Their investing parameters are getting very, very narrow. However, we always look at the team first. Are they going to be good stewards of the money? Have they had success before? Are they good business people? The second thing they look for is, does the business make sense? A lot of people come to ask for investment, and they really don't have a rational business plan. They don't have a business that other people have invested in. It's very common for people to say in angel world, we don't have any competition. That actually scares investors in the sense that if no one else is looking at this problem, is it a real problem that someone has to solve? They like the fact that a lot of people are trying to solve it. The angel investors looking to probably give $500,000 to $1.5 million to a company to start up. You give them about a year of runway, a year of operating capital. Venture capitalists are looking for companies that are not incredibly established, but they do have audited financials. They're usually in revenue, and there's a decent scalability of the business that could become very, very big. As opposed to $500,000 to $1.5 million for angel groups, venture capitalists are looking for at least to invest in businesses, maybe $10 million, $20 million or more. The scale of investment that venture capitalists create is far bigger than the angel groups.
As an angel investor, they're investing their own money that they've earned either through investment or hard work at a job. On the other side, venture capitalists usually have $1 billion fund. When I was looking up about WhatsApp, Sequoia Group at the time, they had a $1.3 billion fund for investing. And that one investment of WhatsApp was able to give enough returns to that whole fund to double the investment, because the whole investment was 1.3 billion and they were getting 3 billion back. When I've talked to people, they said, if you go to venture capitalists looking for $1 million loan, you have to understand they've got a fund of $1 billion. If they loan you $1 million and you make 10 times return, that's 10 million for them. That doesn't even touch the goal they're trying to achieve. So that's why they need big deals, because they're looking for big money. Is that right?
You're correct, Wayne.
And
you're correct in that these venture capitalists have billion-dollar funds. And you're right. Even if you made a great return on $1 million deal, the profit they make really doesn't move the needle. They need to be investing that $1 billion to get 2 to 5 billion in return. And they just can't do it with most businesses. The other thing is, I think that the failure rate in angel groups is very, very high. People sometimes are unaware of it. Probably out of 10 investments in an angel group, 7 of them will return 0. You basically lose your money. The business does not scale up properly and become profitable, and you get your investment back. A couple of others out of the 10 might be a get your money back that you put in. And you're hoping that 1 out of 10 gives you a decent return. But you are correct. You're only looking at maybe a 5 to 10 return on your money. So if an angel group puts in $1 million, they get $5 to $10 million. That's great for them, but a venture capitalist is at a whole different level of investing expectations. So you are absolutely correct on that.
An angel investor group, suppose they invest in 10 startups and they're investing $1 million each. So for this whole group, they've got $10 million at stake. As you said, 7 of them, 0 return. Now, and then 2 of them are break even. So they've gotten 2 million back after investing 10 million. They need that one investment that was 1 million to bring in at least 8 million just to break even based on those numbers. And they'd like to double or triple their money over the time of the investment to beat the stock market. So they don't just want 8 million, they want like 24 million or 30 million, in that range. And so they're looking for someone who can scale and probably at that point be bought out by venture capitalists, or the company's bought by another company. Is that the goal? Is that the hopeful path?
Yeah, you have it absolutely correct. So the people are looking for honestly about a 20 times return or more in their money to not just break even, but actually have capital return to you. And the investing ladder, once a company scales up and they're worth that much more, then the venture capitalists come in and say, okay, great. You've had a few years of business. You're looking at turning profit soon, and we'll come in and buy. And that returns the angel money. And then the VCs also would then be able to go forward and hope to scale that to a much, much bigger business and get their money back. The key thing is, though, you see this in angel groups as well, but venture capitalists want some level of control in the business too. They don't ask for, they expect a board seat or 2 for that kind of money. So they can actually be involved in the business itself. It's also why they make so few investments, but each investment's a lot of money. They actually have to have some level of authority and control in the business. So venture capitalists have to have that expectation that they're going to be assisting the business, not just giving someone a check.
Okay. Yeah. We're almost out of time, but is there any like red flag for an entrepreneur who's looking at angel investors? Are there angels? Are there sometimes where it's not a good fit, and what would be a red flag saying it's not a good fit?
So, great question. So, typically, angel groups are becoming far more specialized. If you're doing agricultural technology, which is actually very big, there are groups that do ag tech, we call it, and nothing else. There's also groups that do, there's also financial tech companies, and all they do are looking at companies that involve themselves in financial markets and financial technology somehow, financial software. So what you're going to see in angel groups is it's highly specialized. The biggest thing I help people with is helping them find a group of angel investors that are tied in to what the business is about. What I'm seeing, people are becoming far more narrow in what I call their investment parameters, what type of business they'll invest in. And that is something that someone in a business needs to identify with a potential advisor or group of advisors. Where's the best place to spend my time? That's the key question. Even angel groups are becoming far more specialized now in what they invest in: ag tech, financial tech, fintech, educational technology, ed tech. They become highly specialized. So a lot of people end up wasting their time putting out applications. What they need to do is find an advisor or two that can direct them to the best places to spend their time. That's critical in the search for money. You don't waste months in places that won't really give you an opportunity. You need to go to the people that are in your space that understand your market.
And is that something that you do? You advise companies on finding the right direction, right place to go, and preparing to talk to investors?
Exactly. In fact, a lot of people come in and say they're looking for funding, and they don't even think about things like loans. A client that's doing a project, building something, I said, that's a construction loan. You don't need to give equity away, but you need a construction loan. That's one example of people are unfamiliar with what type of funding their company should be getting. That would help a lot to talk to an advisor. I do that myself. I try to guide people to the best places to spend their time when looking for money.
Okay, well, we're out of time for this episode. We'll be back in just a minute. I'm Wayne Carroll with David Blackledge, and this is Leveraging Inspiration.